When you deposit your paycheck, you likely imagine it sitting in a quiet, heavy steel vault. But the moment that money enters the banking system, its physical reality is replaced by something else. We are told that massive economic interventions are necessary to save the public from a stalling economy. Yet, despite these rescues, the gap between the rich and the poor continues to widen. The architect of this dynamic is the central bank. In the United States, that is the Federal Reserve, an institution with immense power over economic cycles. The banking system utilizes a specific structural mechanism to conjure money, setting in motion a process that begins moving wealth out of reach for the middle class. In the 17th century, goldsmiths realized that because depositors rarely withdrew all their assets at once, they could issue multiple paper receipts for a single physical coin. They began lending out IOUs for gold they didn't actually have. Today, we call this fractional reserve banking. It is the legalized equivalent of that historical illusion, where banks are required to hold only a tiny percentage of their customers' deposits. This process transforms commercial banks from simple guardians of value into creators of a new currency supply, known as inside money. When you deposit money, the bank keeps a fraction as reserve. The rest is immediately loaned to a new borrower. That loan is deposited into another bank, which issues yet another loan. This multiplier effect generates fresh liquidity entirely out of debt. However, while the digital money supply grows, the physical pool of actual economic resources, labor, raw materials, and finished goods, remains fixed. An abundance of inside money does not equal an abundance of real resources. It simply creates an artificial investment boom based on the appearance of wealth. When the economy stalls, the Federal Reserve steps in to stimulate growth by cutting its target policy rate. A rate cut of 100 basis points acts as a catalyst. It incentivizes borrowing and supercharges the commercial bank multiplier, flooding the market with capital. This strategy traces back to the Greenspan era, when stock market performance became an implicit driver of central bank policy. When the central bank floods the market with this newly minted capital, we have to look at where that money actually lands. This path is the portfolio composition channel. Instead of flowing to wages, new money is directed into financial markets. Equities and housing absorb this capital as investors bid up prices. The bottom 50% of households hold almost none of these assets, leaving them disconnected. As wages remain flat while asset prices climb, the purchasing power of the working class is diluted. This expansionary policy acts as a systemic subsidy for those who already own assets. The Federal Reserve's data, tracked through the distributional financial accounts, provides the proof of this wealth transfer. A 100 basis point rate cut directly shrinks the wealth share of the bottom 50. This upward concentration of capital is a core feature of the modern banking structure. It is the literal physics of the system. The next time the central bank intervenes to save the economy, recognize it for what it is, the deliberate activation of an upward wealth transfer.